Welcome back. Axis Bank has been one of the best performing large bank stocks in the month of May. And actually, since its results on April 28, the bank reported probably its best return on assets that I can remember, 1.8%. Likewise, its net NPAs were, my sense is, the lowest ever that I have seen in the bank's history. And separately, of course, its market share in credit cards has soared after it bought the Citi portfolio. To give us more colour on the future growth levers, I have with me the man himself, Amitabh Chaudhry, Managing Director and CEO of Axis Bank. Amitabh, good morning. Thank you very much for finding time for us. Okay, well, let me start with something which is very common, of common interest now. The 2,000 rupee notes, do you see enough of it, enough people coming and exchanging it? Do you sense that you and the banking sector are going to see some reasonable improvement in deposits and cash in circulation and cash in the current month?
Well, from our perspective, Whither, this is more of an exercise to ensure that the customers are not inconvenienced and we are fully compliant with the expectations of RBI. So the inflows of deposits has been not that large. We have seen about 3,000 crores come into our accounts. We have seen some money come through, less than 1,000 crores come through our recyclers. If you look at the overall size of deposits we have in Axis Bank and what we have seen come through, the numbers are quite small. Whether it will have a meaningful impact on the overall deposits in the system, I think only time will tell. I saw some data about even SBI today. The number, in comparison to the size of SBI's balance sheet, also does not look that large to me. So let's see whether it will have a real meaningful impact or not. Early days, there's a long way to go and people have a lot of time to exchange these notes. One hears that rather than using the banking system, and again, this is all in the public domain, a speculation in public domain that people are maybe using other means to recycle their 2,000 rupee notes. So let's see how it percolates into the system over a period of time.
No, I don't know if you even checked this. It may be too trivial considering the numbers you're talking, but are more people exchanging or are more people depositing?
I think more people are depositing. Exchanging, we are asking for details of customers who are coming and exchange. So I think the customers are better off just depositing their accounts rather than just trying to exchange notes. Obviously, some of them are coming and exchanging for sure, because some of them like to keep some cash with them at all times, just in case of emergency. So the exchange is also happening. But again, the numbers are not very small.
Okay. All right. In any case, let me come to the big talking point, margins. The expectation was that if deposits rise, you could see an improvement in margins. Your margins, that was the only one which didn't grow. A lot of the other, your competitors, showed an improvement in margins in the fourth quarter. Yours is at about 4.22, 4.25, not a big distance. But has it peaked, or do you think there is a chance that it remains at least at this peak for a couple of quarters?
So, Lata, in our case, I think the repricing happened faster on the asset side. So we saw the lift in margins in the second and the third quarter, and obviously a steady number in the fourth quarter. While in case of some of the other banks, the lift was not there in the early part of the financial year, and they saw that lift coming through later. So it is not that we did not see a lift. The lift has come through in Axis Bank numbers also. While we do not provide any specific guidance on NIMs in terms of what will happen going forward, there are a few things I would like to state. We have worked very hard as a bank over the last several quarters to increase our operating and profitability metrics. So, for example, in quarter 4 financial 23, we delivered an annualized ROE of 21% plus, when our NIMs were at 4.22% on an annualized basis, which are up, by the way, 73% year on year, which is the kind of I talked to you about how the it has flown in the margins. For the full year financial 23, and it's an important data point, we delivered an ROE excluding external items of 18% with NIMs at 4.02%. So one is that even if the NIMs were to fall, the bank has demonstrated an ability to deliver ROE which is upwards of 18%. Yes, we saw an increase in deposit costs in quarter 4 financial 23, and we expect the deposit cost to increase further as the repricing continues to happen. However, and so I would expect the margins to trend down a little bit in the next couple of quarters, but our hope is that we should be able to maintain margins in the zone which we've talked about, and the reason we are saying that we will be able to maintain the margins within a certain zone is because we continue to make steady progress on the medium-term drivers of our NIM journey. This include improvement in our balance sheet mix with focus on ROE-led loan growth. So this is obviously higher growth in focus segments, rupee-denominated loans, and so on and so forth, reducing the share of low-yielding RIDF bonds. And we have seen a steady, trend where the holding of RIDF bonds has come down. We had a higher LCR in quarter 4 that will tend down to normal levels, and the repricing of LCR loans. So we believe that some of these initiatives will play out over the next couple of years, and it should help us in mitigating some effect of the increase in cost of deposits. But some of these initiatives will take time. So you will see a trend line which might go down, but we, as we have said continuously and all the times that we have worked very hard to get here, would like to remain in the same zone. So let's see how this all plays out. It appears that we are in for a long pause as far as interest rate cycle is concerned. So hopefully the repricing should also taper down. And then let's see what happens from there on in terms of both the asset and the liability pricing.
Okay, let me take 2 points of the many issues that you put on the table. One, that yes, deposit costs will inch up. I guess HDFC Bank will ensure that, going by their demand for deposits. And secondly, this long pause. There are people who believe that the Reserve Bank may cut. A survey I did indicated at least 2 or 3 prominent economists expecting it in as early as December, and the bulk of them expecting it in March. Okay, but if it were to be in December, then you have a lot of EBLR. So if deposits are going to inch up and your EBLR loans, external benchmark-led loans, have to be brought down, then, is there a chance that we are seeing the best of margins and it could slip below 4?
Well, as I said, on one side, you have what is happening in the market on the margin. And you said that if the interest rates are cut, then obviously it will reflect some of the asset pricing for us. But as I also said with the same breath, that there are a number of other levers which are at play for us, at least especially for Axis Bank. And as we continue to work with those levers, we can mitigate the impact of these, higher cost of deposits and thus a negative impact on our margins. Now, in terms of quarter on quarter, how it plays out, let's see how, what will happen. But we're very cognizant of the fact that we have worked very hard to get there. So we'd like to stay there.
No, I'm not taking that away. We can see that in yours and several other banks as well. But Amitabh, let me concentrate on the other big piece that you all bought, the Citi piece. Even before the merger, I think you all said at the conference call that about 20% of those people didn't join. Now, how is the portfolio performing now? Are there any more people who have left? And how do you see that impacting asset cost as well as, liability cost as well as margins?
So I think when you refer to people, you mean customers. I think about
customers, yes, customers only. Yeah.
So I just want to clarify. I think we have had a great addition to our bench strength with Citi employees coming in, and obviously they continue to stay. The customers came into Axis Bank with their express consent. So obviously they were quite clear that they would like to continue to work with Axis Bank, obviously subject to we meeting their expectations, when they compared, to what they saw and felt and received from Citibank. I think we demonstrated in the March end numbers, we have taken over the asset as of March 1st, that deposits actually went up a little bit. We are seeing the trend line continuing. We see that the customers are continuing to engage with us. And most of the customers and the senior manager of Axis has gone and met a lot of these customers. They have told us explicitly that they would like to expand the share of wallet with Axis, obviously subject to we continue to serve them well. I have seen the trend line continue to move in the right direction. And it's not only just on the deposit side, it is on the credit card side, it is on the asset side. Obviously, please understand and appreciate that the new bookings are happening in Axis Bank. The old assets are with the Citibank systems. So it's very difficult to give a comparison month on month, but the trend line is all in the positive direction. As I stated in our April call, that the real proof of the pudding is when actually the transition happens to Axis systems, which will take anywhere between 12 to 18 months. But the general trend line, the general sense of customers, what we are hearing on a day-to-day basis is positive to extremely positive. So we are quite delighted where we are, though we fully understand and appreciate that the execution remains a key going forward.
Okay. Now tell us about the Capex, the mood in among customers in India Inc. and your own targets. You all did 20%, but some of it was obviously because of the Citibank addition as well. I think without that, it would have been, what, 15% growth in loans?
Yes.
So what are you targeting, and how is the hunger in the market?
Well, let me give you, what our forecast for deposit and, the credit growth is. We are expecting the credit and deposit growth. I mean, the bank credit growth to normalize at around 16%. The deposit growth to be in the, financial 24 will be about 12.5. I think next quarter will be about 15, 16, but for financial 24 will be 12.5, and deposit growth will be 10.5. So the expectation in terms of growth is to some extent muted. If you look at the forecast our economist has given for the GDP growth rate in the in the fourth quarter, I think we are slightly on the higher side. We are projecting a growth of 5.7% year on year. Underlying this high forecast is a strong manufacturing and mining output, much higher than the growth imputed for quarter four from the previous full financial 23 and the forecasts which are coming in within the first 3 quarters of the year. Well, let's see the actual offtake. The numbers will be out very soon. But our expectation is that I think the GDP might end up being slightly higher than what people were expecting. On the Capex outlook, I think there are couple of important points to note. Capacity utilization and the seasonally adjusted capacity utilization exceeded the long-term average in the second quarter of financial 23. And the improvement, we believe, is likely to persist. The aggregate level capacity utilization is also inched up in second quarter of financial year 23, from 72.4 to 74%. The government Capex continues, and they are indicated that they're not going to stop. Indicators of fixed investment, particularly in construction, production and import of capital goods, registered robust growth in November and December. And several sectors we are seeing signs of additional capacity being created in the private sector. So our view is that the Capex is slowly, gradually coming back. The numbers which are being talked about are higher than what we have heard before. I think the confidence is slowly coming in. I think there is also the expectation that the government will continue to stick to all the policies they've announced, even though the election is looming in next year. But government is not going to stop itself or change course in any form and shape. So in that sense, it is giving much more confidence to the private sector. Also, the geopolitical situation, while remaining volatile, is hopefully operating in a certain zone and giving much more comfort to the people at large. So my view is that the Capex is slowly, gradually coming back. But again, as usual, we have to be watchful.
Okay. Well, just a final question, and let me pack a little more in this. We are in the best of times as far as the banking sector is concerned. I believe the governor said that to the directors of the banks as well. Credit costs have never been this low. NPAs have never been this low for the past, decades maybe. Now, do you see any signs of that peaking off? SME loans, unsecured loans, any sense that, yes, the best is past?
So one is that I think when people are going through the best times is when you tend to make more mistakes. I mean, because you assume that these times will continue. So we have to be very, very watchful in terms of what are the kind of decisions we are taking today. If you want to take a bit of a pessimistic view, there are some trend lines which are available that you are seeing a bit of an uptake on 30, 60-day DBD on the personal loans. The quality of credits which are coming for approval are deteriorating a little bit. Their scores are generally lower. So you have to be extremely watchful. My view is that, again, the larger banks have taken lower credit risk. They're sitting on the lower end of the risk curve. While there's a long tail of NBFCs and fintechs which are taking a bit higher risk, relying on not necessarily income, but some factors and matrices which demonstrate income to give loans. And if there was a kind of the credit cycle going the wrong way, you will see an impact coming through there rather than necessarily into our portfolios. But we are going through really, really good times. The gross NPAs, net NPAs are at real lows, both on the wholesale and the retail side. As of now, things stand. There is no negative trend which we are seeing in our numbers. But that in itself worries us that why are the credit costs not picking up a little bit? And that's why we're even more watchful than before to ensure that, if there is any sign of any negative trend, becoming a real trend line, that we obviously change our parameters and become even more careful about who we're lending to and what we're lending to.
Okay, that's the best thing you can hear from a banker, isn't it? That you are terribly vigilant at this point in time. Thank you very much, Amitabh Chaudhry, for spending time with us. A very important takeaway that the Capex cycle clearly is showing signs of an uptick and we should see more demand for loans. We wrap up on Bazaar on that note. Chartbusters up next.